Hello, everyone, and welcome. If you're in my financial accounting and reporting class, you are in exactly the right place. Today, we're going to get into something absolutely fundamental to the balance sheet. We're talking about capital assets. We're going to follow the entire journey of an asset. I mean, from the second it's bought to the day it's sold off, all through the lens of IAS 16 and IAS 36. Ready? Let's jump in.
All right, so here's our game plan. We're essentially going to trace the complete life story of a capital asset. First, how do we even decide to put it on the books? Then, how do we figure out its price tag? After that, we hit a big fork in the road, the cost model versus the revaluation model. From there, we'll get into its working life, depreciation and impairment, and then its final retirement. And we'll wrap it all up by talking about why getting this right is so important for you. So let's start at the very beginning, right? Before we can worry about depreciation or anything else, we have to ask a really basic question. Is this thing we just bought even an asset in the first place? This first step is called recognition.
Okay, so what are we talking about here? Under IAS 16, property, plant, and equipment, or PPE, as you'll always hear it, are tangible items, stuff you can actually touch. And here's the key, they're used to run the business. We're not talking about inventory you're planning to sell or a building you're holding just for its value to go up. This is the equipment, the machinery, the offices that you use day in and day out. And, of course, they're expected to last for more than 1 year. Now, for an item to officially get on the balance sheet, it has to pass these two tests, and it has to pass them both at the same time. First, is it probable? So more likely than not that this thing is going to help the company make money in the future. And second, can we actually figure out what it costs in a reliable way? If you can say yes to both of these questions, congratulations, you've got yourself an asset.
All right, so our item passed the test. It's an asset. The next job is to give it its official starting value on our books. This is what we call initial measurement. And believe me, it's not always as simple as just looking at the purchase receipt.
The true cost of an asset is really built up in 3 layers. Of course, you start with a purchase price, but make sure that's after any discounts you got. Then you have to add in all the costs that were absolutely necessary to get that asset in the right location and condition for you to use it. Think delivery fees, installation, maybe even site preparation. And finally, and this is a really important one, you have to include an estimate of the future costs to take it apart and restore the site when you're done with it. So knowing what costs to add to the assets of value, what we call capitalizing, versus what to just expense right away, is absolutely crucial. This table lays it out perfectly. An architect's fee to design the building, well, you can't have the building without it, so that gets capitalized. But what about training your staff to use the new machine? That's an operating expense. The machine could work without it. The training is about your business operations. Same thing for advertising or general administrative costs. They aren't direct costs to get the asset ready. Okay, we've got our asset on the books at its initial cost. Now the company has to make a huge policy decision. And this isn't just for one asset, it's for an entire class of assets, like all of your buildings or all of your machinery. You have to choose how you're going to measure them from this point forward. And there are 2 main paths to choose from. First, you've got the cost model. It's simple, it's reliable. You take the original cost and just depreciate it over time. It's based on a hard historical number. Then you have the revaluation model. This is a whole different philosophy. Here, you periodically update the asset's value to whatever its current market price is. As you can imagine, this gives a more relevant, up-to-date picture, which is why you often see it used for things like land and buildings where market values can swing pretty dramatically. Now, the revaluation model has some pretty specific accounting rules, and honestly, the best way to get it is to just see it in action. So let's pretend we have an asset that we bought for 100,000 pesos, and we'll see what happens to its value over 3 years. So in year 1, great news, the value jumps to $120,000. Now that 20,000 peso gain doesn't go straight to the profit and loss statement. Instead, it gets recorded in a special section called Other Comprehensive Income, or OCI. The idea is to keep the company's core profits from getting all jumpy because of market fluctuations. This gain creates a special account in equity called the revaluation surplus. Okay, now here's where it gets really interesting. In year 2, the value drops all the way to 90,000. That's a 30,000 peso decrease. But you don't just record a 30,000 peso loss. The rule is you first have to use up that 20,000 surplus we put into OCI last year. That absorbs the first part of the drop. It's only the leftover amount, that extra 10,000, that actually hits your income statement as an expense. And then, watch what happens in year 3 when the value bounces back to 115,000. The logic just flips.
Of that 25,000 increase, the first 10,000 is recognized as a gain in profit or loss. Why? Because it's reversing the expense we took last year. Once that's been repaid, the rest of the increase, the remaining 15,000, goes back to OCI to start rebuilding our revaluation surplus. It's all about symmetry.
So, now that we've got our asset valued, we have to deal with the reality that we're using it, and it's getting older. This brings us to the two big concepts for an asset's working life: depreciation and impairment. Depreciation is just the process of spreading out an asset's cost over its useful life. But the most important rule here is that the method you choose has to match the pattern of how you're using up the asset's benefits. For a building that you use steadily year after year, a simple straight line charge makes sense. For a new company car that loses a ton of value right at the beginning, the diminishing balance method is probably a better fit. And for a factory machine, it makes perfect sense to tie the depreciation expense directly to how many units it turns out. But sometimes an asset's value can take a nosedive for reasons that go beyond normal wear and tear. That's where impairment testing comes in. It's basically a safety check to make sure that an asset on your books isn't listed for more than its recoverable amount. Think of this as a hard ceiling on its value. So what is the recoverable amount? Well, it's the higher of two different numbers. First, what could you get if you sold the asset today, minus any costs to sell it? That's its fair value less cost of disposal. Second, what's the present value of all the cash you expect to make from it if you just keep using it? That's its value in use. Whichever of those two numbers is higher, that's your ceiling. The asset's book value can't go above it. And that brings us to the final chapter in our asset story, the end of its useful life. This is when it's sold, or maybe just scrapped, and we have to officially take it off our books. We call this process derecognition. And you'll be happy to hear the math here is pretty straightforward. The gain or loss is just the difference between whatever cash you got for it and its carrying amount, its book value, at that exact moment. And whatever that result is, a gain or a loss, it goes straight to the profit or loss statement for the period. So we've walked through the whole life cycle, from birth to retirement. But let's zoom out for a second. Why do we have all these detailed rules? Why is this so critical for you as you move forward in your careers?
This quote really just says it all, doesn't it? These aren't just random rules somebody made up. They are the language that accountants use to tell a true and fair story about how a company is investing in itself and using its resources. Getting this stuff right is absolutely fundamental if you want to create financial statements that people can actually trust and use to make smart decisions.
And I want to leave you with this final thought. The next time you look at a balance sheet and see that big number for property, plant, and equipment, don't just see a number. Ask yourself, what's the story behind that number? Is it based on what they paid for it years ago, or what it's worth today? How are they depreciating it? Have they checked it for impairment? Because behind that one number is a whole narrative about a company's strategy, its health, and its future. Understanding that narrative, well, that's what makes you a great accountant.